Hi, friends and clients. Josh and Brian here to talk about something that I think you all know about. There's an election coming up and yard sign season, and a lot of noise in the media about investing and congressional policies and all these different things that people think might impact their portfolios. So we're going to talk about how to avoid making any mistakes during an election year and some of the pitfalls of letting elections dictate how you invest your retirement savings. So Josh, should I change my investing because there's an election happening?
Elections matter, but probably not for the reasons that you think. So during an election year, the markets actually do fine. You're actually less likely to lose money in an election year in the stock market. However, the path of returns can be a little bit different. During election years, you often see the start of the year, the market's a little bit weaker and finishing the year strong. So if this year ends up that way, we could have a rally at the end of the year, but impossible to predict.
So something we talk to clients about all the time is you have to try to not let your political party affiliation impact how you think about investing. You have to keep the politicians out of your portfolio. Talk about how people should do that.
So there's really not a direct link between who's in charge and what happens to the markets. You're best off staying invested through the different cycles. If you only stay invested when your preferred candidate is in office, you're going to sacrifice a ton of returns and a ton of performance in your portfolio.
So we know what's happening in most of your homes. You're watching the news, and if you watch one type of news, you feel like the world is doing good at certain times, and the other type of news sometimes makes it feel like the world is not doing that good. We know that this is very real, and people feel a lot of impact from politics. But as it relates to investing, how should we work on keeping those emotions out of investing?
Vanguard says that a good financial advisor can add 3% per year of value to your portfolio. And one of the biggest parts of additional return is called behavioral coaching. And that means helping clients make good decisions even when their emotions are trying to get the best of them. So helping navigate political environments is one of our big value adds for clients.
So along those lines, we see all the time that investors will sometimes hoard a little bit of cash, or they'll try to get their portfolio more conservative because they think an election's not going the way that they want it to go. How much can that hurt people to hoard some cash thinking, blue or red is not what they want?
People are very emotional about the political situation. A third of people feel like if their party doesn't get control, the economy is going to plunge into a recession within 12 months. So that's both sides of the aisle feel very strongly about that. And not surprising, the data shows that people sit in cash in election years to the tune of over $100 billion of extra cash sitting in money market funds that usually gets deployed right after the election. So they're costing themselves over $5 billion of returns by waiting until after the election result. The market is great at pricing that in ahead of time. And if you wait until after the election, you're going to be playing catch up.
We joke about this all the time. 2016, half the country was going to move for Canada. Then 2020, the other half of the country was going to move to Canada. So the world is usually not quite as bad as it seems.
I started in 2007, and that was when the global financial crisis was really getting into full steam. A lot of clients on the left were supportive of Occupy Wall Street, felt Wall Street was the culprit. And then the other half of our clients, when President Obama got elected, thought President Obama was going to steal your 401k. There was this email going around that President Obama was going to steal your 401k. And we had to spend time talking about that. And every news cycle, whether it's President Biden or President Trump, people get upset and worked up over the politics. But it's best to stay invested throughout those times.
Presidents do matter a little bit. They do influence congressional policy and the national narrative. So what are some examples where that has played out?
So I watch Fox News. I also watch MSNBC. I want to get both sides, hear what our clients are hearing. But even I, this morning, got pretty emotional and worked up. I was in the car listening to a politician talking about something that I feel like they were dead wrong on. The interviewer was talking over them. I felt my heart rate going up. I was getting upset. And luckily I had to stop and get gas. And by the time my 15 gallons were expired, I had a calm moment. I thought, you know what? Even if this legislation comes to fruition, which I think doesn't make sense, I thought of all these great ways companies would get around it. And that's usually what happens. Companies are really good at making money, no matter what the backdrop is. And profits drive the stock market, and that typically will endure regardless of who's in office.
Josh, you've talked a little bit about myth busting lately. You want to talk through some of these political myths around the markets?
So before an election cycle, a lot of times people are trying to predict what's the best stock or best part of the market if so-and-so gets elected. Ironically, green energy stocks did better under Trump, and fossil fuel stocks did better under President Biden. So you can't always predict what's going to happen. The policy they propose on the campaign trail doesn't always translate into investment results. That's one myth. The other myth that we see and hear is that the market wants divided government. We want gridlock. It makes a lot of sense, and I don't think it's necessarily necessarily wrong. However, the market has performed better during unified government versus divided government. So the results don't necessarily bear out the way we thought they would.
Do you think some of that is certainty? Markets kind of like certainty, unified government, you know which direction they're moving?
Somewhat. Well, markets also are hearing they don't like big changes, and unified government can also lead to big changes.
So we're sitting here near the end of August. It's a good time to talk about it. The Harris campaign just released tax proposals, very early tax proposals, and I know that that can cause a lot of fear for maybe business owners or people who are worried about corporate profits. You think any of that actually comes through fruition when someone says it on a campaign trail?
It's hard to say, but what we do is prepare for it ahead of time. So when we're doing our clients' financial plans, we assume taxes go up a little bit. We assume that to be prudent, and that way if taxes don't, we're already prepared for it.
We always talk about having durable portfolios. There's always a reason to get panicked and sell, but it's never a good reason. So there's wars and there's pandemics and there's political changes. Talk about how you design things to be durable.
We can't predict elections, but we can prepare for the eventual outcome. One of the things I think we can be safe in assuming is that both political parties are proposing a lot of spending. So we are likely to have $1 to $2 trillion deficits each year, no matter who gets in office. And because of that, we feel like we need to position portfolios to benefit from higher inflation, continued money printing and deficit spending. So things like real assets, gold, real estate, high quality stocks, those are in our client portfolios, not only because we think they're good investments on their own, but they also have a secondary benefit of helping out during inflationary times and a lot of government spending.
So we have people's portfolios set up to be durable. What should they expect in the short term? What does 2-3 months until the election look like?
I think we'll see some volatility. I think depending on which candidate is polling better, we've already seen President Trump and potential President Harris trade places in the polls. So as that happens, just expect some normal volatility in the markets, and the stock part of your portfolio that is more volatile likely will get you good returns in the long term, but it will be volatile in the short term. So our clients who have short-term cash needs, that's what our bonds for, money market funds, safer things. So your long-term money is in good shape.
So people are already diversified. They should prepare for a little bit of volatility. Maybe turn off the Fox News, turn off the CNN a little more than usual. Try not to get too caught up in it. Anything else people should be doing?
Keep calm and carry on.